So, for those of you who are watching and you're watching on Eugene's channel, my name is Leo. I'm an investor, value investor. I run a YouTube channel where I showcase my stock research tool where I analyze different companies every Monday, Wednesday, and Friday. And I focus on just building a strong investor mindset as well as working into the self improvement side of things to try to build a strong mindset for all those who are looking to get into investing and looking to improve their skills. Now, I'll bring it over to Eugene. For those that are watching on my channel, Eugene is a phenomenal value investor, but I'll let him tell you the whole story.
Hi, guys. My name is Eugene, and I also value investor, and I learn constantly in this field. I also have 10 plus years of experience in running and created my own businesses. Some of them were sold to private investors, and some of them I own and run nowadays. I had some experience in working with web and app development, search engine optimization, marketing, e-commerce, and blockchain. And a couple of years ago, I dig really deep into investing world, learning about Warren Buffett, Charlie Munger, Manish Pabrai, and other value investors. And I also created the channel to educate more people and help to think differently about the investing from the business perspective and improve yourself in finance, business, investing in general.
Yeah, it was, and honestly, it's been phenomenal talking with Eugene. We are actually part of the same Facebook value investing group. So I noticed that he was posting some things on the debt to equity, and I looked at his videos, and I said, "Oh, he has a YouTube channel as well." So let me reach out to this guy and see. And we're we're very similar in age. We have obviously very similar hobbies and interests with investing. So I said, you know what? It'd be great to actually do a video. And so I'm very grateful for this opportunity, Eugene, to actually do this video with you and actually grow this community. So
yeah, and so we're here.
I actually appreciate this time. It's actually really nice.
Yeah, me too.
So jumping into the video, we're going to cover dollar cost averaging. So Eugene, we have dollar cost averaging. We have lump sum investing, two different approaches, and how we can deploy capital. So what are some of the advantages, would you say, on dollar cost averaging?
Well, first of all, for those people who are new to both you and my channel, we need to understand what the dollar sum cost averaging is really about and why it is so famous among popular and modern investors. So when you use dollar cost averaging, you probably have some portfolio which you need to deploy in one or several stocks. And usually if you go to the financial advisor, you get the advice to split all your capital into several parts over the certain period of time and invest portion of its capital into certain stocks or one position as well. And the main aspect here is that you do not try to time the market hoping to get the better price, and you just buy on a certain period of time and hoping that the average stock price or asset price for your portfolio will decrease over the future.
Yeah, it definitely is a much more hands-off approach in terms of investing because you're essentially just following a system. And the best part about it, one thing that I like about it is you're taking away any kind of emotional involvement because you're just allocating the same amount of capital every single period, whether that's per month, per week, or however you have it. And you don't have to worry about, let's say, price dips. And you treat it almost like a savings account. You put, allocate $100 and you just let it ride it through the market. And over time, the asset will appreciate and you'll get it at some points you might overpay for that asset, but in other cases you might underpay for that asset. And over time, it'll just average out to be at an increased position or increased value in your portfolio.
Yeah, definitely. So in this case, you have some kind of a system when you do not depend on your emotions. You just have initial sum of money, or maybe you earn you earn a paycheck and you save some of that every month, and you just invest continuously into certain securities. And this model is really, really popular nowadays because you do not need to have a lot of money in the beginning. But is it really that successful? So maybe we should try to see that on the real charts and real examples.
I think we should. I think we have some data that we've pulled up, right, with the S&P 500. All right,
Yeah.
we can take a look at if you were dollar cost averaging into that and see what that would look like. So I got my screen shared up here. So we're going to look at the S&P 500. Now we can do over, let's say, a year amount. So we'll put our initial starting amount at $0, and we put a monthly investment at about $1,000 each month. Now from January 2021 over to January 2022, if we calculate that, adding $1,000 per month, our initial and our total invested cost basis would come out to be $12,000. Final portfolio value will come out to $12,765, and our annualized return would come out to be about 14.18%. Not a bad return if you just did dollar cost averaging from last year to this year. How would this compare to lump sum investing? You want to cover that? And if we had to do,
let's change some numbers here. So we can add $10,000 as a starting amount. Okay. And we delete the 100,000 investment for every month, and we can just compare the results in this case.
So, sorry, you want to just do the starting amount to be 10,000 and then no additional?
Yeah.
Okay. Do you want to?
This means that you put all your capital at the beginning, so without dollar cost averaging, and you buy the stock or S&P 500 index in this case on the particular date.
Do you want to do
particular price?
Do you want to put this at 12 because 12,000 would be for the 12?
Yeah, let's do that. Yes, okay. Let's do 12.
We'll do that. We'll do 12,000 and calculating that. So our average portfolio cost would come out to be 14,603, and then our annualized return actually turns out to be 21%. Yeah. A higher rate of return if you were to lump sum into the S&P 500 rather than dollar cost average. Now, there has been an aggressive bull market. So that goes with just the 1 year. So in this case scenario, lump sum investing would triumph over dollar cost averaging in this case.
Yeah. And why this is happening, actually? If we look on 1 year period, we can say that, okay, the market is on high mode or on low mode, and we do not have enough information for the next. But if you look on the long-term period, let me show you some example for that. So if we take the long-term period, for example, S&P 500 from 1985, suppose you start early and you invested initial sum of money over the long period of time, and you held it for several decades, statistically, you will get more money when you lump sum with lump sum investing than dollar cost averaging, because if we look on the numbers, there were more ups of the stock market over the history than it were downs. So here we can see that starting from 1985, we took every month from that date, and we just gathered the close price and just calculated how much of that were in positive or negative results. And as we can see that there were ups 286 times and downs were 161. So when you use dollar cost averaging, you basically tell that, okay, I understand that over the long period of time, my stock will go up in price, but over the short period of time, I try to get as low a price as I can. But unfortunately, this not happens a lot of the time.
Right. So dollar cost averaging would ultimately be beneficial if you had a lot more downs than ups, because a lump sum would just, well, if you're having more ups and downs, right, lump sum just makes more sense.
Yeah, definitely. And it is also makes sense when you see that the market is on the low mode. So when you have some percentage of your portfolio already invested in one particular stock or asset, and you have additional cash which you need to deploy, and you see that the stock goes below the price which you bought the initial asset, you can do the average dollar cost averaging strategy. So in this case, you will receive a lower price for your asset. But if you do this consistently over the long period of time as a systematic approach, you will get higher price for your purchase.
Right. I think that the added benefit of dollar cost averaging, and we touched upon this, is just the whole emotional aspect, right? Because once you do and commit to lump sum investing, you've committed to that sum of money, wholeheartedly invested, and now you have to ride that wave up and down with whatever capital you put into it. And for some people, I'd probably argue for most people, that's an incredibly hard thing to do, and that's what people make wrong decisions in investing, because your emotions get involved. And as soon as your emotions get involved, you're going to either pull out or make further mistakes. So dollar cost averaging, I feel, is a much more safer mode of investing, because you take that emotions out and you just ride it up or ride the market down. Doesn't matter what's happening.
Yeah, this method is good from that point of view. But if you look for the long-term gain, and you see that you need higher returns,
right?
I think that dollar cost averaging strategy is not so suitable in this case. And we can get and add here another example with Facebook stock, or Meta, which is called now. So here we have another example. Let me just change. And here we have also the table with closed prices for Facebook shares for last 5 years. And we can see that if we can compare two methods of investing, dollar cost averaging and lump sum investing, suppose that we, in the first case, invest $13,000 and we do it consistently for 13 months, doing $1,000 every month. And we buy shares of this particular stock. So in the first month, we bought 7 shares for $151.46. Next month, 150, etc. And this, on the other hand, when we invest all our money, we just invest all $13,000 and we bought 86 shares and we just hold them for a long period of time. And if we compare the result over the 5-year period, so in the first case, we bought our first share in May 2017, and the last several shares on May 2018. In the end, we will receive $15,217, which is 17.06% on our initial investment. But if we do lump sum investing for this particular period of time, in the end, we will receive $17,206. And this will be 32% for our portfolio, which is twice higher than in the first case. So what do you think of that?
I mean, I think it's fascinating. And what's interesting is that, well, currently we both have a position in Facebook. So these are 2017 prices, which it's interesting to look at, because we both, and we discussed about this earlier, when we bought into Facebook recently, I took a dollar cost averaging approach, and you did a lump sum investing approach. Now, we don't know how those are going to play out, but what I did was I calculated the intrinsic value of Facebook to be roughly worth around, let's say, $300 something a share. And then I initially bought in after their first earnings report back in February, when prices dropped to around 240. So I bought it at 240. And then as prices slowly started to decrease, I was just averaging my costs down. So now my costs are around maybe 220-ish in that realm. But what the table you pulled up here is brilliant to look at, because if you could just scroll up for a quick second, Eugene.
Yeah, sure.
Yeah. So you, okay. Yeah.
That's
So
the
if you
example of
bought in
this.
at the 151, that, yeah, lump sum investing into that, you'd get the lowest price possible, essentially. Because then
Yes, because if we can see the average price for this whole year, it would be 172.
right.
But in the beginning of May 2017, we bought the whole, we deployed all our capital for $151.
Yeah, you lucked out. Now, out of curiosity, what happens if do the numbers change if you were to, let's say, bought at the July price, let's say 169? How would that affect your returns? If
Yeah,
you lump
definitely.
sum?
It also depends on the time when you enter the market,
Right.
depends on the condition, on the earnings, because when the company releases a quarterly report or annual results, the price can go significantly up or down. But we can do kind of average timing when there were no quarterly reports or any specific news about the company.
Yeah. That's the thing, right? With lump sum investing, and as we discussed earlier, it's an all or nothing approach. And in a case like this, it yields way more higher returns than dollar cost averaging can ever pull out, because, well, you got to be in it. You got to be fully in it, fully committed. Where dollar cost averaging it's a much more safer approach. And if we go through your chart here, we definitely are able to get the stock at a lower price in certain scenarios. Like from May to June, there's a little bit of a price decrease, but then as we see, the price starts to just take off, jumping to 169, 170, and then eventually it does come down to 159 in what year? But my screen is blocking that. There's that one. Can't see because my camera's in the way. But I would definitely go down to 159, and then afterwards 172, and then back up to 191. So there's a lot of jumps, which is it's very fascinating. But so you're laughing when the price is decreasing, but when you're in lump sum investing, who knows what your emotional status is as you're seeing the price rise and then eventually fall. That's the other component. So
while doing the lump sum investing, you need to be very disciplined with that, because when you see the price dropping, you maybe have more passion or motivation to buy more, but you need to stick to your percentages in order to diversify your portfolio. So this kind of challenging.
Exactly. I mean, let's see if I can just turn it over to the. I'm gonna bring it over to my calculator here for a quick second, because I wanted to touch upon almost like a hybrid version of, and we briefly touched upon this, where you can somewhat integrate both dollar cost averaging and lump sum investing. Now, this is something, and I'm assuming you do this as well, where if I have a certain amount of capital that I wanted to deploy, here, we will pull this up here. I'm wondering if we're able to see that. I'm just roughly put some numbers in here. Not too much of a crazy margin of safety, but we're averaging out to be around $400 a share for Facebook using my calculator. Now, ultimately, I want to be in the conservative and moderate price range and buy within this window. Granted, we're at $200 a share, so that's fine if I buy below this price. However, if I had, let's say, $10,000, I have now a choice to either lump sum all of it into this price and just ride it out, or do the alternative approach and, let's say, allocate potentially 70% of that capital to lump sum investing and leave the next 30% to dollar cost average. Now, why would someone potentially do that? Well, if you're lump summing in 70% of your capital, let's say it's $7,000, and you're able to pick up $200 a share, that potentially could be the lowest price you'll ever get. And then let's say if the price goes up by small increments and you dollar cost average into it, it won't affect your average cost too greatly. However, if, let's say, the price does go down, now you're getting that added benefit of getting a lower price while still having a pretty good entry price from your lump sum investing. Now, this is I haven't deployed this strategy personally on Facebook. I've used this with like other stocks. I took a position in Alibaba. Now, that's a company that I've I deployed a decent amount of capital in, and then afterwards used I think let's say if my total position, 60% probably was lump sum, and then the other 40% end up being dollar cost averaging into it to try to bring that price as low as possible. Right. The price that I entered in was decent, but I wish I could have gone a little bit lower. It would have made more sense to just wait and then lump sum into it. But that kind of cushioned the blow. It's just another way of trying to utilize both strategies to try to get the best of both worlds.
Yeah, and when you're learning and get more strategies and more ideas for how to invest better, you can combine all these strategies together. So, for example, if you have the portfolio of 3 to 10 stocks, and
Right.
you have the certain percentage in every one of the securities, and you see that, for example, Facebook went down in price and you want to buy more. But on the other hand, Alibaba stock went little up. So you can just sell some of the stocks from the second position and just bought the shares which go down. So in this case, you kind of rebalance your portfolio, and initially you will achieve a little higher results.
Mm-hmm. So I think for like just the average person that's looking to get into investing, because now we've explained the benefits of either going the dollar cost averaging route or the lump sum route. And what would be your recommendation if someone were to dollar cost average into, let's say, a particular stock or ETF? What would you recommend, Eugene?
Well, I would personally do more deeper research on the particular stock or security, and then I need to understand how much money should I invest as a total over the long period of time, and understand personally for myself, is it better to put the portion of this money every month or every different periods, or should I take the whole sum if I had this and invest in a particular asset?
Right. So it really comes down to a perspective, and then just being able to commit to either one approach or the other, or use a hybrid of both. If you have this capital just sitting around and you want to invest it, but you don't want to commit to either one or the other, and you want to, let's say, use what I just said earlier of allocating, let's say, 70% to, let's say, a lump sum, or 70% to dollar cost averaging, however you want to slice it or dice it, the main thing comes down to just perspective. Are you looking over a 10, 20, 30-year period, or is it a short-term period? Like we just covered in the beginning part of the video, looking at the S&P 500, if you were to just a lump sum into the S&P 500 from the beginning of January, that would have been the correct choice, right? To just sit on that money and just ride it out rather than dollar cost averaging. So in a short-term perspective, in a bull market, that might yield better results. But over the long term, you got to look at your emotional, you have to look at your emotional stability and how you're going to handle these markets, because as we covered in the 30-year example from 1985 to pretty much the present day, there's been a lot of ups and downs in the market. There's been recessions, there's been crashes, there's been different wars and different conflicts that have all affected the stock market. Are you able to actually maintain your composure while the stock price is going down? If you're lump sum investing, that's something that's hard to do, right? Because as we covered, you're going to see this massive price decrease. Are you able, and then eventually it might rise, but can you ride that wave? That's a huge question you have to answer.
That's the most difficult part. But as we all and our viewers, beginner and more skillful, are more value investors, so we project that we will get the return over the long period of time. And by that I mean 5, 10, 15 years at
exactly.
least.
Yeah. I mean, I don't know about you. I'm a fan of bear markets. I like bear markets because that's where you make your money.
Yeah, definitely. Me too.
And I'm assuming your viewers will probably agree as well, right?
Our viewers also more kind of value investors, and that's why I try to present some ideas and present the methods of thinking for value approaches and value investing in general. So that's all for today, guys. I hope you enjoyed the video and it was really useful for you. Today we spoke about dollar cost averaging, how we can use it in our investment strategy, and how you can benefit it while making your investment decisions. If you have any additional questions or comments about our video or any ideas about future videos, please write them down in the comments below. We will definitely look through them and respond on every of your comments. Thank you for watching. Bye.